Afternoon. Good afternoon to everyone. Thank you for joining us today. We have a wonderful program for you. We think you'll definitely enjoy it. It's on overdraft. So the program title is Overdraft Programs: Searching for New Solutions. We think you're going to really enjoy this. My name is Catherine Baxter. I'm going to be your moderator for today's event. But before we get started, let's go over a few housekeeping items. So if you're having problems hearing me right now, please adjust your volume so that you can hear me clearly. From this website, we do want you to allow pop-ups. You'll notice there's a Q&A feature on the right-hand side of your console. And so we'd like you to ask questions throughout the webinar. Don't wait until the end because we will have a Q&A session at the end of this webinar. And of course, in approximately 1 week, what we're going to do is close caption this webinar so that it will be available for on-demand viewing in our learning management system. Now, before we start our webinar, or rather before I start introducing who we have to speak to you today, we have a disclaimer that we have to read to you. And it says, the materials presented in this webinar are intended as an informative and educational summary of general information on overdraft programs. The NCUA has taken reasonable measures to ensure the quality of the data and other information produced by the NCUA that is available in this presentation. The NCUA, however, makes no warranty, express or implied, nor assumes any legal liability or responsibility for the accuracy, correctness, or completeness of any information that is available through this presentation, nor represents that its use would not infringe on privately owned rights. The slides are intended for educational and discussion purposes and do not constitute legal advice nor replace independent professional judgment. Reference to any specific commercial product, process, or service by trade name, trademark, manufacturer, or otherwise does not constitute an endorsement, recommendation, or favoring by the U.S. government or the NCUA. So now, what are we going to present today? First and foremost, it is always my distinct pleasure to listen to remarks by Todd Harper. He's our NCUA board chairman, and he's going to talk to you today about some encouraging information relative to this webinar. And then we're going to introduce our speakers, and they will get us into our overdraft program discussion. And then following that, we're going to have a Q&A. So now it is my extreme honor to introduce to you Chairman Todd M. Harper, and he's going to address our audience. Todd, you have our attention.
Thank you so much, Catherine, and good afternoon, everyone. I am pleased to join today's webinar on overdraft protection programs, and I appreciate your interest in this important and complex topic. I also want to thank staff from our Office of Credit Union Resources and Expansion, as well as our two presenters from the Filene Research Institute, Luis Dopico and Taylor Nelms, for making this discussion possible. Today's topic is a significant one, especially as the debate about overdraft programs and related fees is reaching an inflection point. Accordingly, many credit unions are considering how to restructure their programs and even drop overdraft fees entirely. These decisions will require adjustments to revenue expectations, especially as overdraft fees make up a sizable proportion of non-interest income at some credit unions. This webinar will highlight how to align overdraft protection programs with a credit union's mission, its business structure, and the needs and expectations of members in a rapidly evolving financial services environment. In my view, the overdraft fees charged by some credit unions can be detrimental to members and are inconsistent with the system's mission of meeting the credit and savings needs of consumers, especially those of modest means. The Consumer Financial Protection Bureau reports that overdrafts and related fees of credit unions took $2.4 billion from the pockets of members in 2019. To put that in perspective, that amounted to 1/4 of all fee income for federally insured credit unions during that year. The dependence of some credit unions on these fees is clearly a safety and soundness concern as well, especially in an environment where consumer expectations are changing and overdraft fees are falling. The COVID-19 pandemic has also raised the public's awareness and concerns about these programs, as consumers awaiting the clearance of stimulus payments were sometimes charged hefty overdraft fees. Effective overdraft protection programs require careful and thoughtful planning, and institutions must be sensitive to the burden such programs place on their members, especially people of color. After all, member service is at the core of the credit union system. Nearly 130 million Americans have entrusted credit unions and the NCUA with their hard-earned savings and financial security. Punitive overdraft fees can harm consumers, and households hit by frequent fees often have their checking accounts closed. And Black and Hispanic consumers are much more likely to get charged overdraft fees. As a result, such fees can lead to financial exclusion for people of color instead of financial inclusion. For that reason, the NCUA has prioritized a review of credit union overdraft programs as part of its supervisory priorities for 2022. This year, our examiners will request information about a credit union's overdraft policies and procedures, as well as the monitoring tools and audits of credit union overdraft programs and member communications. We anticipate using this information for a more thorough review of credit union overdraft programs in 2023. A growing number of credit unions and banks have, of course, eliminated or greatly decreased their overdraft fees in the last 2 years. I recognize, however, that not all credit unions are ready to make this change. If your credit union is going to maintain an overdraft program, I encourage you to consider features like linking to savings accounts, offering affordable lines of credit or short-term small dollar loans, and helping your members build savings. Additionally, as more institutions dramatically increase overdraft fees or drop them altogether, consumers will expect your credit union to follow suit. So it's time to start rethinking your overdraft program. The good news is that credit unions that have already made the switch have created new income streams. You too can diversify your revenue streams in creative ways. For starters, build your member base and originate more safe, fair, and affordable mortgages and other loans. Once you make those loans, service them and offer other products that your members need. These are just a few ideas, and I am certain there are others. Today's webinar will assist you in considering what options are viable for your credit union. I also hope that today's discussion will yield valuable insights that you can incorporate into your credit union's strategic business planning. Thank you for taking the time to listen and learn today. Catherine, now back to you.
Thank you, Todd. Franz, can you let me share my screen again? I appreciate it. And what we're going to do now is we are going to introduce our speakers. And so our speakers for today, our first speaker, of course, is going to be Luis Dopico. He's the chief economist with CU Collaborate, and Taylor Nelms, who's a senior director of research with the Filene Research Institute. But before I turn everything over to Luis and Taylor, Franz, would you put our first poll question out for our audience, please? We want to know who we have in our audience today as far as credit unions. So here's a question that we have for you. What is the asset size of your credit union? Are you in the $0 to $50 million range? 51 to $250 million range? Are you in the 251 to $500 million range? How about the 501 to 1 billion? Are you greater than 1 billion? And of course, we do know that there may be some in the audience today that are not credit unions. We'll give you a few seconds to answer that. So again, 0 to 50, 51 to 250, 251 to 500 million, 501 to 1 billion, greater than 1 billion, or not a credit union. What is your asset size? We'd like to know who we have in our audience. We have quite a few in the audience today, so we'd like to know that. So Franz, can you let us know what our audience has answered today in our poll question. Let's take a look and see. Let's see. Wait, here we go. Okay. So we have quite a few that are in the greater than a billion range and also the 51 to 250 million range. We also have a few that are not credit unions that are joining us today. So we thank you for that. That's very interesting. We have a nice mixture in our audience today. Right in the middle and right at the very top are the largest categories that we have today. Thanks, Franz, if you don't mind. So now what I'm going to do is I'm going to turn everything over to Taylor Nelms, who's the Senior Director of Research with Filene Research Institute. And Taylor is going to start us off. Thanks, Taylor.
Catherine, thank you so much. Really appreciate your introduction, as well as the invitation to speak here today. I'm going to share my screen, and hopefully folks will be able to see that very soon. As Catherine said, my name is Taylor Nelms. I'm the Senior Director of Research at the Filene Research Institute. Luis, would you like to introduce yourself briefly?
Yes, my name is Luis Tapico. I'm currently the Chief Economist at CEO Collaborate, a consulting firm that specializes in helping credit unions better serve their members and grow. And I've been doing that since August. Before that, I worked very closely with the Filene Research Institute for 20 years. So Taylor and I have worked together for many years.
Thanks, Luis. Luis and I are here today to talk to you about one of the hottest topics in consumer finance, overdraft. Thank you again to the NCUA for the invitation to present our research on credit union and bank overdraft programs. And thanks especially to Chairman Harper for his introductory comments. Todd, you've covered much of the context that we'll introduce here today. So thank you very much, incredibly useful. We're very much looking forward to the next hour or so of conversation, next 45 minutes or so of presentation. So here's our agenda for the day. After this brief welcome, we'll kick things off by reviewing some of that broader context. Then we'll review recently released research from Filene, led by Luis, that provides some detail into the current state of overdraft programs in credit unions. And I want to take a moment to thank Redwood Credit Union and Michigan State University Federal Credit Union for their leadership and support of this research. The research does not reflect their views, but appreciate their support in making the research happen. For those looking to access the full report and dig into the specifics, you can download that report on Filene's website. So that's filene.org/553 to access this report. We'll end with 15 minutes of discussion and Q&A, and we'll be very excited to hear from you. So please don't be shy in asking questions along the way. So we're going to start also with a quick poll. We know that the context around the assessment of fees by financial services providers, especially overdraft, courtesy pay, and non-sufficient funds fees, that context has shifted dramatically over the past 2 years. And I think it's fair to say we're in the midst of a fee evolution, maybe bordering on a fee revolution. So for those in the audience who work for a credit union, to the best of your knowledge, is your credit union today having any internal conversations about eliminating or overhauling your overdraft protection or courtesy pay programs? Just a simple yes or no. And of course, we're not tracking who responds which way or what other. We're just trying to get a general aggregate understanding of, for those in the audience, how are you tackling this, this topic? Are you starting to think more substantively about restructuring your programs? So let's see if we can get that poll up. There it is. And I'll leave it open for a minute or two as I continue to talk, and then we'll check back in to see what the results are. So, you know, as I said, while conversations about the fee programs of financial services providers have been ongoing for some time, really since 2020 and the outbreak of the COVID-19 pandemic, we've seen an increasing explosion of interest and, importantly, experimentation with overdraft, courtesy pay, and non-sufficient funds fee programs. So in response to new competitive dynamics, shifting consumer expectations, wholesale public debate about such fees, many credit unions are now taking proactive steps to eliminate, reduce, or restructure their overdraft or ODP programs. This is an important topic in a moment for credit unions because, as we'll discuss the discussion around overdraft, and Chairman Harper hinted at this already in his comments, really opens a window onto a much more profound set of conversations about consumer financial well-being and financial inclusion, and about the evolution of non-interest income and ultimately the future of credit union business models. So let's take a moment, let's check back in with our poll results. If we can see how folks have responded. Are those in the audience looking to restructure their programs? And it looks like out of those who answered, so it looks like about 2/3 have answered, about half of those who answered say yes, that they are considering eliminating, reducing, or restructuring their fee programs. I think honestly that speaks to much of what we found in our the qualitative side of our research as we conducted it over the past 2 years. So quickly, before we really dig in, what do we mean by overdraft programs? Historically, overdraft emerged as a strategy to provide an alternative for consumers whose purchases might otherwise be denied at the point of sale. I think that history is important. It all started with the bounced check in many ways, right? Credit unions implemented or sought to implement a service like many other financial services providers to cover the cost of that transaction and take the risk of the bounced check or failed ACH transaction from the merchant side onto the financial institution side. And credit unions assumed that risk. They offered it typically as a last resort, and usually they priced it to discourage use, right? Since that time, we know that overdraft protection has become one of a variety of ways that financial services providers approach that challenge of how best to serve consumers when their immediately accessible savings runs low and they threaten to overdraw their accounts. So one of the biggest takeaways from this report is that there's already a great deal of diversity and complexity in how credit unions structure their overdraft programs. And we know that terminology can differ from organization to organization, but within this broader category of overdraft protection, we really take this kind of holistic approach. We include all of the following on the screens, right? So we were really looking very comprehensively at the variety of options that credit unions have and have implemented to address this overdraft issue. So there is real complexity here, which itself poses a challenge for credit unions and credit union leaders, as well as staff of credit unions and, of course, members themselves. And we'll talk a little bit about that trade-off a little bit later on. What's happened in the space since 2020, really since we started this research? You've already gotten a fantastic overview from Chairman Harper on the current landscape and pressures facing credit unions. So I won't go into too much detail, but by and large, we have seen many financial services providers eliminate or reduce or restructure their overdraft programs, and especially their overdraft fees. In many ways, digital neobanks and fintechs really led the way, with large commercial banks and credit unions following suit. But what's driving these changes? Well, we know that consumers have changed. How consumers pay for goods has changed, with big shifts from checks and ACH over longer history to debit and credit usage and other forms of electronic payment. Consumers' expectations of financial services providers have also changed, and consumers have, in general, become more fee averse. Technology has also changed. So as a result, information for consumers is more transparent. It's easier to access and keep track of your account balance, for example. And on the operations side, it's also true that the cost of running overdraft programs has also dropped. And the competitive landscape has changed. As we see here on this slide, we're seeing increasing competition around fees, especially when it comes to the attentions of young people, new entrants in financial services, especially non-bank and neobank financial services providers. Ultimately, in our research, we saw that credit unions are increasingly benchmarking themselves and their performance against those fintechs and neobanks. So as one credit union CEO told us in a webinar not too long ago, credit unions face a relevance threat. Finally, the external environment is also quickly shifting as consumer advocates and other key stakeholders are encouraging financial institutions to rethink the role of fees, especially overdraft fees, especially in light of the potential negative impacts on consumers, as we'll discuss. So in 2020 and growing into 2021, Filene launched new research to begin to better understand the current state of overdraft programs among credit unions. But what brought us to this point? Let me turn it over to Luis. Luis, overdraft programs have material impacts on credit union balance sheets, as well as on consumer budgets. It's one important part of the mix for generating non-interest income for financial institutions. So what's driving the business side of overdraft and the growing conversation around it?
Yeah, thank you for that one for the introduction. And also thank you to the chairman for his earlier introduction. And yes, we have already discussed why overdraft protection programs first came to be. They were introduced to try to help consumers deal with the situation where they might be short of cash. We also know from everything that everyone has heard in the media that the revenues that come from these programs have grown over time. Well, how big are those programs? What are the long-term trends in which those revenues fit? Through this slide here, we try to answer that question a little. And I'm not going to say anything that is completely new to anyone, but I'm trying to give us a numeric long-term picture. Basically, over the last 40 years, we have living in a period of decreasing interest rates. Interest rates have decreased economic-wide, they have decreased for loans, they have decreased for deposits. The next few years may be different, but the last 4 years have involved overall a long-term decrease in interest rates. As interest rates have decreased, we also have had shrinking margins. As banks and credit unions can charge less for loans, they can make smaller revenues. Now, credit unions are a relatively small participant in loan markets. So in this chart, we show the net interest margin that banks have. And we can see that over the last 30, 40 years, basically net interest margins for banks have fallen by at least 100 basis points. We could pick different dates to start or to end, but we can clearly see that net interest margins have compressed a lot by more than 100 basis points, which is more than the average net income that a typical credit union has. As banks have faced narrowing net interest margins, credit unions operate in the same markets. If banks are charging lower interest rates, credit unions have to charge lower interest rates also, because otherwise they will not have any customers. Beyond that, credit unions pride themselves in charging lower interest rates than banks. So obviously, as net interest margins fall, for banks, they also fall, as we see in this chart for credit unions. The blue line for credit unions and the red line for banks are basically parallel for the last 30 years. Now, we have seen that credit unions and banks are making less money from the interest side. What are credit unions and banks going to do? If they want to continue to offer services, if they want to continue to serve their members, if they want to continue to have employees to do that, they have to get revenues from somewhere else. And that somewhere else, if it's not interest, it's non-interest. It's basically charging members fees. We can debate what types of fees should be charged. We can debate their structure. We can debate how some fees might be more or less consumer friendly or member friendly. But this chart shows us the big picture of the economics. That credit unions didn't wake up one day and decided, oh, we're going to charge lots of fees. It's simply they responded to the economics of the market in which they operated. If net interest margins fall for over 100 basis points over the last 30, 40 years, then the obvious reaction to that was having to increase revenue somewhere else, and it was by increasing non-interest income fees by about that same over 100 basis points.
Yeah, and part of what's driving this broader kind of macroeconomic shift on the consumer side is the changing ways that consumers are using financial institutions. So from core deposit taking and lending, still the bread and butter of most credit union businesses, financial institutions these days, at least in the eyes of consumers, are in the business of helping consumers manage and move their money. What that means is that a larger and larger portion of credit union balance sheets is driven in part by earnings from that non-interest income side, and that includes payments as well as other sources of non-interest income, not just fees. So there's a broader story here to tell about the evolution of the credit union balance sheet and the role that financial institutions play in consumers' lives. Part of the puzzle, of course, is that while free checking, quote unquote, free checking has almost become fully ubiquitous across financial institutions in the United States, providing financial services costs money, right, Luis?
Yes. And there obviously isn't a perfect link between the amount of services that you charge and the number of employees that you have. You can try to be more efficient with how much you do with the number of employees that you have. There is not an exact link between expenses and services, but let's face it, there is a link. If you want to provide more services, you have to spend more. And if you want to provide more services and you have to spend more by having more employees, by having better technology, by having branches, then you have to pay for that somehow. And you can pay for that somehow through interest revenues, but we have seen that that's become harder over the last 40 years. The alternative is, well, you have to get those revenues from the non-interest income side. And what this chart simply shows is, in an anonymous way, I'm not telling you which credit unions were participated in our study. You can look at their non-interest expenses, and you can see that, well, those credit unions that choose to have higher non-interest expenses because they want to provide more services also happen to charge more in fees. They also happen to have higher non-interest income. And that brings us to the question of, if we suddenly decide that, oops, we want to give up some types of fees, some types of non-interest income because we are concerned that it's not fair or that it's not consumer friendly, then tough decisions need to be made. And those decisions will have to be, what are we going to do? If you give up this type of revenue, you either have to come with alternative ways to have those revenues, or you have to cut some of the services that you provide. Now, Chairman Harper pointed out very correctly that one way that credit unions can try to get new revenues is by increasing the amount of loans that they make. And that's a very important point, because across credit unions, there is a great diversity in loan per assets ratios or loan per share ratios. A lot of credit unions have high loan per assets ratios. They turn a lot of the funds that they receive into loans, but a large number of credit unions have surprisingly low loan per assets or loan per share ratios, and that's an area that is prime for exploration, especially as you try to reduce your overdraft protection fees.
Yeah, thanks so much, Luis. So with this context, the macroeconomic context, the social and kind of environmental context, we entered into a deep study rather than a wide study to explore this quickly shifting competitive landscape of overdraft programs. So we interviewed a small selection of credit union leaders, digging deeply into the current state of their ODP programs, and more importantly, their non-interest income strategy and motivations and some of the decision-making calculus behind revisiting that strategy. We collected even more detailed information from some of those credit unions on the structure and financials of their ODP programs, and then we conducted some mystery shopping at several large banks to construct a comparison set. It's important to note, I think, that we conducted this research right in the middle of all the change that we've already discussed. So while our findings provide, I think, a very useful snapshot, if we were to conduct this research today, the current state will have shifted. Overall, though, I was extraordinarily struck in this research, and Luis, I think you too, by the credit union leaders' deep and careful thinking about this topic, both in terms of impacts and implications for consumers and impacts and implications for their cooperatives. So Luis, what did we find? Who is it from these credit unions that's using the overdraft protection programs?
Well, what we found is that the overwhelming majority of members sign up for overdraft protection. So they have that protection in case something unforeseen happens to them. But while the overwhelming majority of members have signed up for overdraft protection, that doesn't mean that they overdraw on their accounts. So we call the large majority of members that may have signed up for overdraft protection, but that do not actually overdraw their accounts, we call them non-overdrafters. And they turn out to be the overwhelming majority of members, 82%. Now, we also found that, well, some members do have things that happen to them. They may make a mistake in the value in their account. They may have a personal crisis, and they do overdraft. But it turns out that they are obviously 82% do not overdraft. The fraction of members that overdraft is relatively small. So it is not 82%, it could be a total of 18%. But even out of those, the large majority overdraw their accounts very rarely, maybe once or twice a year. And with fees that, to simplify, might be $25 per overdraft occasion, this large fraction of members that overdraw rarely, they overdrew, they're not happy about it, they may not be happy about the fee that they were charged, but paying $25, $50 is not a large occurrence in the financial life of most Americans. Now, what we did find, however, is that there is a small minority of consumers who are heavy overdrafters. And we define that for simplicity as those that overdraw at least 3 times a year. But it turns out that some overdrew even more than that. The average was 10 times per year. Some cases, some extreme cases, could overdraw dozens of times or even more than 100 times per year. Now, within heavy overdrafters, we don't have the data to break it down precisely, but there are at least 2 subclasses. There are the ones that we call crisis overdrafters, and these are people that probably haven't overdrafted for years, and probably in future years they will not overdraft again. But something may happen, a personal crisis, unemployment, a death in the family, divorce, disease, and they may have a large number of overdrafts within 1 month. Then there are another type of overdrafters, which we call habitual overdrafters, who are people who overdraw their account on a regular basis. And these consumers approach overdraft in a completely different way than the rest of us might think about. Whereas the law or the regulation might say that overdraft protection is not a form of a loan, that it is not credit, these members say, well, I'm getting close to the end of the month, I'm short in cash, I need $100, I have a hard time getting a loan. Well, I will just overdraw my account and I know I will pay a fee. The fee may be large, but given the circumstances, that's a decision that they make in a reasoned fashion, and that they think is the best thing that they can do.
Yeah, and there is other research that we cite in the report and that's available more broadly to characterize some of the demographics and, again, behavioral patterns of these heavy or habitual overdrafters. And you can see some of those characteristics on the right-hand side of this screen. And there is some behavioral surveying to show that they do see overdraft as a way to borrow and therefore as a way to manage their monthly budgets. One way to look at this, I think, is, just from the member side, from the heavy overdrafter perspective, it's clear that for many of these people, overdraft fills a need. Whether it fills that need well or poorly is a different question, but it's clear that that there is an unfilled need among those consumers who use this on a regular basis. And the question then becomes how to fill that need in a safe, fair, accessible, and affordable way. So, Luis, we did find some really interesting things between, in that comparison between credit unions and banks. In the interest of time, let's move through this relatively quickly, but tell us a little bit about what we found about the differences in the way, similarities and differences in the way that credit unions and banks structure their programs.
Yes, and as you mentioned earlier, we did this. We carried out this research last year, and we asked about conditions during the year 2020. So if we repeated this study again, the results might be different. But I do think that there is value in what we find, and that it gives us a valuable picture of how things stood. And if we repeat it, we can see how things evolve. But by and large, we found that whereas banks and credit unions are not identical, the types of programs that are offered by banks and credit unions are roughly comparable. And whereas banks and credit unions may not charge the exact same fees, again, the differences in the fees that are charged are not huge. So for instance, credit unions the credit unions that participated in our study had overdraft fees that range between $25 and $32. The banks that participated in our study had fees that range between $29 and $35. Credit union fees are lower, but they are similar. And we, as you said, well, in the interest of time, as you said, I'll try to speed it up a little. We did find some differences, and we can look at them a little more in the next chart. But the one thing that came through in our interviews is that banks approach overdrafts as a profit maximizing matter. The banks may decide that they will stop doing overdrafts because there is a market pressure on them that consumers don't want to pay their overdrafts, and they may transfer their money to another account, to another financial institution. And in that case, banks will respond. Credit unions, however, were not, by and large, in their interviews, they clearly showed that they felt strongly about this issue. They were worried about it. They weren't waiting to respond to market pressures. They really wanted to explore whether overdraft protection fit their mission.
Absolutely. And so we saw credit unions already taking, as far back as 10 to 12 years ago, taking some proactive steps to surround their overdraft programs with efforts to reach out to consumers, especially those heavy overdrafters. And often that became formal processes for many of these credit unions. We don't have to spend too much time on this very busy slide. I've color-coded it maybe to make it a little bit more readable. You can find this in the chart, in the full report, I should say. But what we tried to do is just simply kind of categorize where banks and credit unions stand on many of the details in how ODP programs are structured. I think important, Luis, that we talk a little bit about the overdraft revenues and charge-offs. So maybe can you tell us a little bit about that situation among credit unions?
Yes. So obviously, I'm an economist. I like numbers. So to be able to have an informed discussion, we need to go beyond saying this is good or this is bad. We need to know how big of an issue is it. And we did that. We collected data from our participating credit unions, and we found that revenues from ODP programs are sizable, but they are not huge. And to quantify that, basically among our participants, ODP revenues amounted to about 13% of non-interest revenue. Now, that's the average. Some credit unions relied very little on it. 3% of their non-interest revenue came from ODP. Basically, these credit unions could do away with whatever remaining fees that they have, and they wouldn't be financially affected. But there are other credit unions that relied on ODP revenues quite heavily, up to a third of their non-interest income. These credit unions would have a harder time making a transition, and they're going to have a harder discussion. I've said that in terms of a percentage of your non-interest income, you can present the same numbers as a percentage of assets, where they average 17 basis points, and they range between 3 basis points and 38 basis points. 38 basis points is a large number. It would mean about half of the net income that the typical credit union has. So that's how big ODP revenues are. The question arises, well, why do you charge revenues? Why do you charge fees for this service? You want to charge fees, obviously, because you don't want to give money away. You want to give advances to people. You hope that they pay you. And some people do not pay back. And those advances have to be charged off. Credit unions want to organize programs such that they cover their costs. And well, one way to figure out how well that's working is to compare the charge-offs on ODP advances versus the revenues that we're getting. And basically what we found is that charge-offs amount to about 8% of ODP revenues. And what that simply means is that credit unions are operating ODP programs in a relatively conservative fashion. 8% means that, well, you could cut your fees in half, and still charges would be far less than the amount of revenues that you would have, or you could experiment with increasing the limits, the amounts that you give in advances to people. And again, the charge-offs would still be a lot less than the advances. So these are things to experiment with. The other thing to take into account is that in an earlier slide, we mentioned that most members pay overdraft fees very rarely. And as we said, it's 2%. Now we're seeing that in some credit unions, up to 33% of net interest income is coming from ODP, and that means that you could have 2% of members, those with the lowest incomes, those with the weakest credit, would be contributing a very outsized large fraction of the non-interest revenues that a credit union has. And the fees that they are paying are not being used to cover charge-offs. In practice, they are being used to finance other services. And this leads us to a complicated situation where, in essence, you have the members with the weakest incomes, with the weakest credit, paying very large amount of fees. And those fees are being used to finance services to other members with higher incomes and with stronger credit histories. So as far as I can tell, I don't know how to say it politely, this doesn't seem to fit exactly with the social mission that credit unions want to have.
And what we heard loud and clear from many of the credit union leaders who we talked to on the qualitative side of our analysis, and Luis is an economist, I'm an anthropologist, so we complement each other well. We heard loud and clear from them that very concern, that the impact to consumers and the effective cross-subsidization from one small, typically well-off group of members to a larger, typically better-off group of members was a primary motivation for many credit union leaders to take action on rethinking and restructuring their overdraft program. So this isn't simply, right, an empirical finding. It's certainly here. It's also one that is loud and clear, very present in the decision-making calculus already of many credit unions and credit union leaders. Luis, I want to make sure that we have lots of time for Q&A, so why don't we skip this slide, which really focuses in on some of the comparisons between an alternative in the minds of many consumers to an overdraft advance, the credit card line of credit, right? And some of the outsized impacts that an overdraft advance can have when compared to the interest rates that one might get on a small credit card expense. Instead, I think it is important that we kind of summarize here the sea change that we're seeing in the approach of credit union leaders to overdraft, and maybe to non-interest income more broadly. Some leaders we heard were responding to pressures from competitors, to the changing environment broadly. Others were seeking to claim a differentiator, to distance themselves proactively from competitors and appeal to consumers. Others were looking to reevaluate the very purpose of overdraft. Some have argued in the past that overdraft offers a way to inform or nudge consumer behavior. Many have noted that how ineffective that has been, and we see the consistent use of overdraft by that small percentage. So some are seeking really to kind of rethink overdraft, not simply as a feeing mechanism, but truly as overdraft protection, right? Support for consumers in moments of need, and then to experiment with alternatives. And then finally, noting that disproportionate impact that fee assessment can have on poorer households and people of color who are disproportionately poorer households. Many leaders are thinking in terms of equity and inclusion, asking themselves explicitly how to make their organizations more equitable for consumers and thus align that part of their business operations with their credit union's mission. We do have one more poll, and so we'll go ahead and ask it, and then very quickly I think we can transition into Q&A and discussion. But many of you said you were considering eliminating or overhauling your overdraft protection or courtesy pay programs. What's your motivation for doing so? You can choose multiple answers here, so please choose all that apply. And as we collect these responses, we'll talk a little bit about the ways that credit unions are already experimenting. And you heard some of this from Chairman Harper. I encourage you to listen to his remarks again. There's a lot included already in there, but in some, the time is right for credit unions to revisit and begin to experiment. And Luis, do you want to talk very briefly about what are some of those experiments that credit unions are engaging in around restructuring their overdraft?
Yes, the wide variety of experiments, and it's interesting because some of the experiments are pushing in opposite directions. Now, the simplest experiments are simply saying, well, these fees are too large; they are not accomplishing the intent that we wanted. They're not necessarily getting people to overdraw less often. So some credit unions, some banks, some fintechs are eliminating ODP fees. Others are reducing them by a large amount. But beyond those, there are other ways to try to help members that are coming up short with money at the end of the month. And the simplest way to do it is to say, well, they are coming to us for credit because they cannot get credit elsewhere. So instead of charging people a fee, the main thing that a lot of credit unions are experimenting with is trying to ease habitual overdrafters into various types of loan programs, be it line of credits, be it credit cards with small balances, be it small dollar loans, be it workout loans. The other types of experimentation that are taking place are very interesting in that they show us a trade-off between simplicity and responsiveness. So some credit unions have very simple overdraft programs where they charge everyone $25, and then they worry that, well, that system is not very responsive in that you run into the situation where you wanted a proverbial cup of coffee for $2 and you got charged $25. And that's something try to make this a little more complex, and they might say, oh, we're going to have fees that depend that have different sizes, or we're going to charge you a fee of so much, so many times a day. If you get beyond that, then the fee is going to be of a different size. Now, in the other hand, we have credit unions out there that already have very complex overdraft programs that have lots of rules that try to protect the members so that all these examples of unfairness are not a problem. Well, what those credit unions apparently run into is that their systems are so complex that the members do not understand them. They don't know, oh, how many times can I overdraft per day? What's the size of the fee going to be? And not only did we find that the members did not understand the programs, what we found, which was most surprising, is that a lot of the employees of the credit unions do not understand those programs themselves. So they have a hard time explaining the programs to the members. Whenever an issue arises, they have to pull out the manual, they have to read it, and the systems are so complex that if the employees can't understand them, then how can we expect the members to understand them? And that simply tells us that there's a lot of work to be done ahead, and the questions are hard, and we need to keep working, but we don't necessarily know what all the answers are going to be yet.
Thanks, Luis. Absolutely. So you can find in the report some recommendations. I won't go into them here about what credit unions can do. Instead, I'd love to transition into some Q&A. Let's see the results of the polls. Yeah, so interesting, a nice variety here. Definitely, we're seeing some trends here in terms of trying to see exactly what the different options are. But that first option, some of those middle options, and the last options, seem to be the most popular. So really, nice to see credit unions really thinking hard and carefully about this issue. Let me transition back to Catherine. I will stop sharing my screen, and we'd love to get your questions and see if we can answer them in the time that we have remaining. Catherine? Catherine, if you can.
Sorry, you know what? I unmuted and then I muted again. Sorry.
No worries.
I think I let everyone know that, we're going to be going through a few bugs as we transition on this new platform. Okay, so here's the first question. So to both you, Taylor, and to Luis, so the person said those that eliminated the fee, did they create other fees or increased other fees such as minimum balance fees, or possibly add a monthly or increased a monthly fee for the joy of just having the account at those large institutions? That was a lot of questions. Hopefully you can see the the question in the Q&A.
Yeah, I mean, it's a great question. We did see some experimentation among certain credit unions who were seeking to remake the non-interest income mix on their balance sheet. In other words, to reduce the amount of revenues, earnings that they were receiving from overdraft and other fee sources, and then to supplement that by usually it was through value add services or some kind of tiered checking account rather than just a monthly fee. I think the competitive marketplace is such that a monthly fee might be difficult to sustain, although there are still examples out there of credit unions who do assess like a $1 monthly fee or a $2 monthly fee, often in support of philanthropic foundations or other mission differentiating activities. So we did see some of that. Luis, I don't know if you have anything to add. We did also see a lot of movement from credit unions who simply looked at how much money they were making from overdraft and said, you know what, we can eat that. And many of the folks who are kind of first movers in this space among credit unions are often those who are seeking to kind of scale out of the problem of foregoing revenue on overdraft.
Okay. Luis, did you have something to add to that as well?
Yeah, I mean, what I would say rhymes very well with what Taylor has said. A lot of the participants in interviews told us that they thought that free checking was a failed experiment, that free checking was basically a way through which middle class members are now paying less, but the revenues needed to come from somewhere. And they were doing higher fees to the people that can afford them the least. And ideally, an ideal solution to that would be to go back to a way holding for account. The problem, however, is that the competitive landscape that is and what it boils down to is, over many years of research, I have learned that if you charge fees on loan, if you charge interest rates on loans that are unattractive, your consumers will leave. You will make fewer loans. If you pay interest rates on deposits that are unattractive, your depositors leave. If you spend less marketing, you're going to have less growth. But as far as I'm less responsive to fees. So when financial institutions are making choices and they're having to decide, okay, what are the different margins? What are the different wheels that I'm operating? It turns out that the squeaky wheel is the one that gets oil. And credit unions find that it is harder to increase interest rates on loans, that there are consequences if you decrease interest rates on deposits, that they have areas in which they want to spend money, and the easiest way to generate revenues is through fees. And we want to move away from fees that are the least consumer friendly, but it is difficult to do in a marketplace where not everybody else is trying to do the same things that you are.
Okay. So this person actually that asked that question had a follow-up. So let's see, why don't we just ask that question? It says, have those revenues grown due to the need of and acceptance of the consumers? And if eliminated, what is the option for the consumer when funds are tight?
So there's really two questions there. The first is, I think the experiments are too early for us to know what kind of growth we can expect from kind of the marketplace and from innovations on non-interest income revenue. In terms of alternatives for consumers, we identified a bunch of those, and credit unions are in fact identifying a bunch of those. Luis, do you want to talk a little bit about some of the more creative ones that you were considering, that we were considering in this research, specifically around lines of credit?
Yeah, I mean that would be. I don't know how creative it is, but the main line of investigation that I think we should pursue is shifting people from saying you have a $200, a $500, a $1,000 pay advance for which we're going to pay you $25 per time that you overdraw, to simply saying, oh, instead of charging you $25 for a $2 advance, we're going to give you a line of credit attached to your checking account of the exact same amount. And on that, we can try to charge whatever interest rate we think is necessary. Maybe the maximum, 18%. But 18% charge on $100 would be $18. If you overdraw by $100, right now you're charged a fee of $25. If you overdraw by $2, you get charged a fee of $25. So simply, credit unions need to pursue very heavily shifting from courtesy pay to having small line of credit.
I think the key insight from the report is that obviously there's a great deal of diversity among credit unions in terms of their memberships, as well as in terms of their business models and revenue drivers. So the most important thing is to understand who your members are. Start there. Why are they overdrafting? And it may be for your institution that they're overdrafting because they need that consumption smoothing at the end of the month or at the end of the week or on a daily basis. It may be that your members, there's really only a very small percentage of members who are overdrafting, but it's not the same ones every month or every year, right? And in that case, your solution would be different. Ultimately, we think that there are multiple markets and multiple market needs within the kind of broader category of users of overdraft or courtesy pay or those who are assessed non-sufficient funds fees. So we think it's very important for you to tailor your solutions to your members and what they need for their particular budgets.
Okay, great. I think we have time for 2 more questions. Before I ask these final 2 questions, just to let our audience know, we will make the slides available in our learning management system. And also this webinar is going to be posted on our YouTube channel, so you'll be able to see it right away after today. And also we're going to send a survey out to all of you that's going to pop up in your web browser. So please expect that. Here's the question. This is a good one. Something about the matrix that we're involved in coming up with the data, Taylor and Luis. It says, the person says, considering the large number of credit unions below 1 billion in assets, why were only 3 out of the 16 institutions researched in the below 1 billion range?
We always look to include a diverse representation of credit unions when we go out and do research. I'll be perfectly frank. Oftentimes, those smaller organizations have less resources and less time to commit to original research with the folks like the Filene Research Institute. We would love to be able to have a much wider, more diverse sample set of institutions that for all of our research, whether that's our DEI, Policies and Practices Survey, which you can take online right now at the Filene Research website, or any of the work that we do in collaboration with system partners like CU Collaborate. We want to be able to be as inclusive as possible in accessing data and representing the industry. It's just simply the case that there are fewer people at those institutions, fewer resources and time and energy often to commit to original research like this.
And also, beyond looking at the number of credit unions, if you compute things as a percentage of members or a percentage of assets, it turns out that a very small number of large credit unions with over $1 billion of assets accounts for very, very large percentages of total members. So whereas we might not be representative of credit unions in terms of count, we were far more representative in terms of actual members.
Absolutely,
Awesome.
Luis. Thank you. Yes.
Okay. And so our final question, and then we're going to have to go because we're running over a little bit. This is a good one too. There's a discussion among financial institutions to modify overdraft programs. Has there been discussion with the payment networks and with merchants to no longer allow charges to go through if there are not funds in an account? That's a good question.
It's a great question. I don't personally know of conversations. I know that folks in the payments industry, whether those are the network providers or many of the credit union specific partners that organizations in our industry work with, are very much on top of current trends. And so I am sure that it's been a conversation internally, but I don't know, personally the outcome or the progress of those conversations.
And also the question always has to be, what does the consumer want? The consumer may realize or may not realize what their balances are in their accounts, but a lot of consumers want the transactions to go through. The question can be, what when they need an advance, when they want an advance, how much do we charge them? And members can, to a large extent, very often, opt in or out of programs where they can say, I don't want to be charged a fee, I don't want the transaction to go through, and I may or may not be charged a fee depending on the details of the program. But a lot of members don't necessarily want for the system to deny their expenses. Even if they don't have the funds, they may want an advance, and they want, when you are at the grocery store and you're paying $100 for groceries, you don't necessarily want to worry about whether your paycheck came through on time or not. You want that transaction to go through.
Absolutely. That makes a ton of sense. Thank you, Louise. Thank you, Taylor. We thank everyone. We're going to have to end our webinar now, but I guarantee you all of these questions that you all have asked, we're going to have them answered when we load this webinar in our learning management system. So if you are a credit union employee, board member, executive, volunteer, you will have access to this particular webinar in our LMS. So please check back with us in approximately 1 week, and we will post the answers to these questions along with the handouts and this webinar itself. Thank you again, gentlemen. Louis Dopico and Taylor Nels. We also thank Chairman Harper. And also I'd like to thank Franz Aiento. He's our behind the scenes guy. He really helps us out a lot. And Patty Hunt, who helped us out with the Q&A. So thank you all. Have a wonderful afternoon. We'll see you later and have a great week.